For nearly a century, one silent signal has whispered before every major economic collapse. It warned us before markets crumbled in the 1930s. It flashed again before the global shock of 2008. And now, it's glowing once more. This isn't superstition. It's not magic. It's something measurable, visible, and surprisingly simple. The yield curve. In this video, we'll uncover what the yield curve truly means, why it has predicted almost every recession for the last 100 years, and what its recent inversion is trying to tell us about the world's financial heartbeat in 2025. Imagine the global economy as a living organism. The bond market is its pulse, the heartbeat of trust, fear, and time. When investors lend money to governments or institutions, they receive interest in return. Short-term loans usually pay less, while long-term loans pay more, because the future carries more uncertainty. If you were asked to lend money for 1 year, you'd accept a small reward. But if you were asked to lock that money away for 10 or 20 years, you'd demand more. That's normal. And when plotted on a chart, it creates an upward sloping line called the yield curve. It's a quiet visual of confidence. It tells us that investors believe the future will be stronger than the present. But sometimes, the curve does something unnatural. It flips. Suddenly, short-term loans offer higher returns than long-term ones. That's the market's way of whispering, something's wrong with the future. When the curve inverts, it suggests that investors have lost faith in growth ahead. They start seeking safety, not opportunity. They pour money into long-term bonds, driving those yields down, while short-term yields climb higher. It's the bond market's version of a storm warning, calm on the surface, but lightning on the horizon. This signal has been astonishingly accurate. Before the Great Depression, the curve inverted. Before the oil crisis of the 1970s, it inverted. Before the dot-com bubble burst, inverted again. Before the global crash of 2008, same story. Every time, the world looked the other way. And every time, within months or years, economies stumbled. But here's the twist. The inversion itself doesn't cause the collapse. It simply reveals a deeper imbalance. A moment when confidence breaks, when money stops flowing naturally, and when fear quietly replaces optimism. Today, that same pattern is back, but it looks different. The curve has been inverted for an unusually long stretch. Central banks have pushed interest rates higher to tame inflation, while long-term expectations remain weak. It's like a bridge stretched too tight, tension everywhere, yet no visible cracks. Some experts say, this time is different, but history rarely agrees. Every time those words are spoken, the pattern reminds us that human behavior doesn't change. Only the backdrop does. This inversion isn't a prediction of doom. It's a mirror, reflecting uncertainty, debt, and doubt across nations. In recent years, central banks have become major players in the bond market. By buying or selling massive amounts of bonds, they've started to reshape the curve, sometimes flattening it artificially. This intervention blurs the old signals. It's as if the compass we've relied on for decades is now slightly magnetized. The question becomes, is the yield curve still a reliable warning? Or has human interference changed the laws of the storm? Global debt is higher than ever, growth is uneven, and technology now moves money faster than policy can react. When fear spreads today, it spreads instantly, through screens, signals, and data. One rumor can shake markets in seconds. That means if history repeats itself, it could unfold faster, sharper, and louder than before. The same old warning, now amplified in a digital age. The yield curve isn't just about finance. It's a lesson in cycles, patience, and human emotion. It tells us that every boom carries its own shadow, and that no period of calm lasts forever. But it also teaches that after every decline comes rebuilding, renewal, and growth. The curve doesn't predict despair, it predicts change. And for those who listen closely, it offers wisdom that numbers alone can't capture. Because in the end, it's not about fearing the next inversion. It's about understanding what it means and being ready when the curve whispers again. The next chapter of the world's economy is already being drawn, in technology, in energy, in the way humans connect and trade. Each decision today reshapes the curve of tomorrow. Each moment of discipline, innovation, or understanding bends that line towards stability or chaos. But the truth remains, cycles are not enemies. They're teachers. They remind us that growth without balance is fragile, and decline without hope is temporary. The curve, bends not to scare us, but to teach us that the future is never fixed. It's drawn by our actions, our patience, and our courage to learn. Trust is the invisible currency that binds every economy together. It's what gives value to paper, meaning to markets, and direction to growth. When that trust is strong, the curve rises naturally, upward, confident, hopeful. But when it weakens, the line bends inward, reflecting fear's return. Every inversion, every recovery, every expansion, all are stories of trust gained, lost, and earned back again. It's not numbers that drive nations forward, it's belief. And the yield curve is simply belief made visible. Every ignored warning has a cost, not in numbers, but in confidence. When trust fades, economies lose their foundation, not through collapse, but through hesitation. When investors doubt, spending slows. When policy lags, uncertainty grows. And when fear replaces clarity, even the strongest markets stumble. The yield curve's message is subtle. It never shouts. It waits, patient and consistent, reminding us that timing is fragile and awareness is everything. Those who ignore the signal repeat the cycle. Those who respect it learn to move with it. Every generation experiences its own version of "this time is different." But inside that illusion, the same emotions live: hope, fear, denial, and discovery. During the calm, before each storm, the curve inverts quietly, as if whispering beneath the noise of optimism. The signs are always there, but they're ignored, dismissed, or explained away. And when the wave finally arrives, it feels sudden, but it never truly is. The eye of the storm isn't chaos, it's clarity. It's the moment when illusion breaks and truth surfaces. And in that silence, those who listen to the curve aren't frightened, they're ready. Every warning holds two sides: fear and foresight. The same curve that signals risk also shines light on resilience. When economies fall, something greater always rises: innovation, discipline, and rediscovery. The downturns of history gave birth to revolutions in thought, industry, and creativity. From crisis came change. From scarcity came strength. The yield curve's inversion isn't a prophecy of doom. It's a reminder that correction is a natural part of renewal. It's nature's balance, written not in soil or stars, but in numbers and trust. When the world contracts, it breathes in. When it expands, it exhales. And within that rhythm lies the truth: no fall is final. Every civilization has its cycles of growth, excess, and renewal. The yield curve is simply the modern echo of the ancient truth. It reminds us that time itself moves like a wave, rising and falling, expanding and contracting. Those who understand its rhythm are never truly surprised by change, only prepared for it. So when the curve bends once more, whether this year or 10 years from now, remember what it really says: not the end, but the turning. Because the world's economy, like life itself, doesn't move in straight lines. It moves in curves, each one whispering the same message: learn, adapt, and rise again. For the first time in history, knowledge travels faster than the crisis itself. People can watch the yield curve move in real time. Information spreads before consequences unfold. This awareness changes everything. It doesn't prevent the cycle, but it gives us a chance to respond with wisdom, not panic. The future may still be uncertain, but the understanding of signals like the yield curve makes humanity stronger than ever before. In a connected world, awareness is power, and preparation is peace. The next downturn may come faster, but so will our ability to rise again. Behind every data point are people: workers, families, dreamers, and builders, each living through the waves of expansion and contraction. When economies slow, it isn't just numbers that fall, it's confidence, security, and opportunity. But as history shows, the same people who endure the downturn become the foundation of the next rise. The curve reminds us that economies are built not only on policy or markets, but on the persistence of human effort, the will to keep going even when the world contracts. In every era, there are those who look at the curve and see fear, and there are those who look at it and see a chance to prepare, to learn, to adapt, and to lead. Every cycle ends the same way it begins: quietly. Not with panic, but with a gradual shift in behavior. Confidence fades slowly. Spending slows. Caution replaces excitement. And then, as always, the pendulum swings back. New ideas emerge, innovation revives growth, and the same curve that once warned of collapse begins to rise again. The economy heals in layers, first through adaptation, then through reinvention. What once seemed like a crisis becomes a chapter in the story of resilience. Because the yield curve doesn't just track money, it reflects humanity's rhythm of fear and recovery. Each inversion is a reminder that our systems may break, but our ability to rebuild never fades.